Hi there, it's Azilia here from Tax World. Today I'd like to talk to you about Section 89 of the Taxes Consolidation Act 1997. Section 89 deals with the valuation of trading stock when a business ceases its operations. Trading stock includes items typically sold by a business, as well as work in progress and raw materials used in manufacturing. When a business stops trading and sells or transfers its stock to another trader, the value of the stock must be assessed based on certain rules. If the stock is sold to another business that can deduct the stock cost as an expense, the closing stock value for the business that ceased should be the same as the opening stock value for the buying business. In other cases, the stock should be valued at its open market value on the day the business ceased operations. When stock is transferred to another trader, the valuation depends on the relationship between the two parties. If the parties are not connected, the value should be based on the actual price received. If the parties are connected, the value should be based on the price that would have been received in an arm's length transaction between unconnected persons. If stock is transferred to someone who is not a trader, the value must be the higher of its acquisition value or the actual price received. An acquisition value is the price that would have been tax deductible if the stock was sold at an arm's length price immediately before the business ceased. This rule applies if the stock's value exceeds both its acquisition value and the price actually received. Both the seller and the buyer choose for this rule to apply and include an election in the buyer's self-assessment return, signed by both parties. Lastly, the value assessed for the trading stock of the ceased business is also considered as the purchase cost for the buyer. I hope you found that useful, and I'll see you in the next video.